Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:05 a.m. Central Time, and I'm recording this in preparation for the market day, January the 30th, 2015. Full disclaimers are at the end of the video, but you should be aware that this is for educational purposes only, and only you are responsible for the investing and trading decisions that you make. So let's dive right in. Let's see. First of all, what happened in our overnight? Well, a lot of weakness across the broad market, so we get the very threatening activity, the first of the yesterday's action, and you come down, you visit the bottom of the range that's been established in the last couple months, bounce off that range bottom, move up about a percentage point to the middle of the range. So very broad-based bullish response, and yet when it was all said and done, we just ended up back in the middle of this 2-month range. So very complex range consolidation or consolidation pattern, but bottom line, we're left with no real clear direction as to which way this was going to break out, whether it's going to be a bullish breakout or going to break down. The overnight action would seem to say that on light volume that people were taking opportunity of this rally to sell it. So we'll have to see how the bulls come in with the full participation of the market today. But down quite a bit on the cousins of the S&P and Dow, less so on the Russell and NASDAQ. Obviously, especially this time of year, earnings plays can influence overnight response, especially in the NASDAQ or Dow, where a handful of companies can dominate the performance of the entire index. And overseas action, China again down big. China has really taken a hurting in recent days, down 1.6%. Hong Kong down 0.36%. Japan up 0.39%. Germany flat, and the United Kingdom down about 0.39%. So very mixed response in our sisters overseas activity. In terms of macroeconomic reports for today in the U.S. markets, you got GDP, and certainly that is a key, one of the probably big four macroeconomic reports. This is the advanced GDP. So obviously anytime GDP is being talked about, it's a significant view of how well the economy is doing. You also have a couple that come out during the trading day today, Chicago PMI and that Wiley University of Michigan consumer sentiment. You never know exactly what time that's going to get released. It always seems to be a little fuzzy, but anyhow, be aware of those. If you are intraday trading, you'll have those come right into the middle of your morning session. You will have also volatility to deal with, and one of the things that we do here is we look at volatility not just from a VIX measure, and here we use the short-term VIX 18.78 currently for the S&P 500, but we also look at where are we with historical implied percentile, and we're right in the middle of the range. So certainly there's nothing extraordinary about our current volatility. We're right around the 52-week mid-range. But we certainly have seen a different type of volatility, and that is range. We've seen more than one standard deviation movement, several trading days in a row across the various markets. The Dow perhaps the most volatile, where you've had in the last 6 trading days, 5 of them have had at least a standard deviation move between top and bottom. So we often are having this significant range going up and back down within the range of the 2-week chart pattern, and yet not really putting an awful lot of fear that would be reflected by put buying and expanding VIX ratings. So a couple different ways to look at this, but one of the things that we like to keep in mind is, okay, well, what kind of ranges are we dealing with on our intraday trading? And we certainly have seen an increase in that kind of activity in this month of January as we come to a close of January. So keep that in mind. We're certainly seeing big ranges, and yet at the same time, not necessarily an awful lot of fear. Obviously, VIX is higher than it was last summer, but it is certainly not by any measure, significantly high. I mean, when we start thinking about above 20, and even above 25, that's where there's significant fear coming into play. It is certainly elevated, but it is not a super fearful marketplace right now, as reflected by put buying. In terms of our daily report, we remain much the same condition. We're still calling this phase 3, but really what this is it's a range, and we're waiting for the establishment of a higher high and a higher low. But we really don't have anything that fits perfectly into our phases. Uptrend under pressure continues. We're still calling for no new short-term or intermediate-term bullish trades from our active trader market posture. You have from position sizing, it's calling for up to 50% on the one opinion, and the volatility-based opinion up to 75%. So somewhat reduced position sizing. Market timing continues to be short-term, relatively bullish on the 1-day, 3-day, and 2-week, but market forecast does come across as decidedly bearish across all 4 broad markets. So not really calling for any new short-term or intermediate-term initiation of trades. Hedge status remains threshold level 1, so we're under elevated risk. And this basically we think of as yellow light. Lots of volatility-based measures still in play. We have our market and decline warning, sharp increase warning from yesterday, as in 2 days ago. VIX spike fired a couple days ago. VIX is still above an 18. No new distribution days with yesterday's up day, but we're still at 4 in the S&P, and if you go to 5, that can raise the hedge warning status from level 1. We could potentially, depending on how other factors, may even go to level 2. So you can see we're right on the precipice here of not just being level 1, but perhaps even elevating that up to the next level. Quite a bit of risk aversion from our key intermarket indicators of our intermarket relationships. So not a lot of institutional risk on trading being put on right now, and as retail traders, you should be very much watching what the big boys are doing and be very careful about putting on risk on type trades or new bullish swing trades in an environment in which the institutions are not playing friendly for you. Option income strategies are currently outside the acceptable volatility window, not conducive to option income strategies at this time. We have, let's see here, in our sector market posture, remember we continue to be right around the neutral on this, so the lines are flat, so they flip up and down and rapidly change these indicators until we actually get something of a trend. These aren't as valuable as normal. Probably the most important thing to do is to note what the relative differences are between the sectors. We continue to get the risk off sectors. Consumer discretionary isn't necessarily risk off, but consumer discretionary and consumer staples have both in general held up better than some of the other sectors. Healthcare, of course, has been holding up better. Utilities continues to be the hero. Retail has had a pretty good run, thought to be benefiting from these lower gas prices. In terms of yesterday, obviously big bounce, carried everybody up, just like the day before, carried everybody down. So very difficult short-term trading unless you are just simply taking the sides of the range and buying at the bottom of the range and selling at the top of the range, and going with very small, quick profit targets, and doing some very nimble type of trading. And that should take care. Oh, same. I think it's the same 4 or 5 here at the top: retail, railroads, transportation, internet, healthcare, and biotech are our top half dozen industry groups that continue to remain in the same relative rank order as a group. So certainly, if you start dipping your feet, your toes into the water, you may want to take a deep look into those industry groups. So, as always, we very much appreciate you liking us on the YouTube channel or on your other favorite social media platforms. We should be everywhere that you want to be in terms of the trader community: Twitter, Facebook, StockTwits, Scootify. I believe on Scootify we are heading towards 1,000 followers, and certainly would love to see us go over that milestone. So, but that's how to find us on these various social media platforms. And as always, your support and questions sent to support@falconglobaltraders.com is greatly welcome. More information available on the website. Your disclaimers, hit pause if you need more time to take a look at that. And then, of course, we always thank you for your participation with the Falcon Global Trader community. Good trading.